it's going to a new reality, and our measurements, based on a variety of factors, not just looking at silver itself, is that this move is going to take us to a new reality, and much of it is going to occur in a few quarters. And we begin that clock. In other words, where did the couple quarters begin? We begin it at the November close. And the reason is, it was at that point in time that when we looked at the relationship of silver price to gold and plotted it as a spread, ounce of silver into an ounce of gold, it's a certain percent. Okay, you just simply plot that chart, and it was a ceiling that went back years, quite a few handful of years, where you go up and bump a certain level and bump a certain. Silver just couldn't get above that value of gold. It broke through there in November. We've gone back and found other few instances of this type of behavior where silver said, I'm out of here, okay, versus mama gold. And it went vertical for a couple of quarters after that.
According to Michael Oliver, silver could hit $300 to $500 within 6 months as the T-bond market crashes. He warns the Fed is losing control and years of price suppression are about to explode upward. Gold may reach $8,000 using its historical eightfold pattern. The crisis could unfold in days, not months. Thanks for watching. Give a thumbs up and subscribe to Fine Metals for the latest insights.
It's no longer laborious. It's going to go vertical. There probably will be, I think, a correction in this process. But our technical work coming at these markets from different angles, by the way, not just looking at the price and the momentum of price, but at the spread relationship between silver and gold. The baby metal mama currency and the big old mama currency. And silver's vastly undervalued, historically speaking, to its prior relationships to gold. And I think that's going to change dramatically and suddenly. And that's the key word, sudden. I think we're in one of these, what we call a move to new reality. It's occurred in other markets. We found an instance of it. It occurred in copper back in 2005 to 6, where copper, in a matter of a couple quarters, quadrupled in price on its own, without help from any other market, and went from an old, multi-decade horizontal reality and just said, boom, I'm out of here. And quadrupled, a new reality.
Yep.
Lead did that in 2007, which was ridiculous. But, it did. How come silver has still been caught in that half-century $50 to $4, $50 to $4 range, and only recently has broken out in this 6-month swing in silver? Like, get us into February, let's say, maybe, but with headlines. And you could, here's the thought that I've put out there. The Supreme Court is going to decide on tariffs. Most people don't know which way they're going to go. I have a strong suspicion they're going to say no. And that they are seeing this broader than just a legal case about tariffs and how they read the Constitution or whatever. They know that what's going on in the world now, especially today, for example, where you read that headline, that sell all U.S., they could step in and put their foot through that door and maybe stop the tariffs and therefore, quote, save the world, if you know what I mean, by stopping the panic selling of U.S. assets, by cutting off his tariffs against Europe, for example. If that were to happen, but a panic first, okay, T-bond climb, don't be shocked if silver goes vertical for several days. Like maybe it doesn't pause till it's $120, $130, and maybe has a couple limit up days, 10% per day on the COMEX. There could be a point in there where if they decide that way, and it's got to be days away or a week away, Supreme Court decision, but I can't find specificity on that.
Right.
You look on the internet, you won't find it either.
I'm Googling right now.
Yeah. And that could try to temporarily put a hose effect on this fire. It won't ultimately stop it because there's far bigger things underway here. But that could be one of those events where silver goes berserk prior to that. Stock market gets gut kicked another day or two like it's doing today. And the T-bonds move into what could be called a panic sell-off. To give you an example, stupid one, but I've put it out before and people think that's his target. It's not. If you go back and look at the bull market from 1976 to 1980, it was an eightfold gain in gold, 8 times. Okay. But look at 2001 to 2011, eightfold move from the prior bear low to the bull market high. Our bear market low was 1,050 in December 2015. Eightfold is what? Okay. 8,000 plus. That's just to do what gold has already done twice in the last 50 years under far less dramatic fundamental conditions. Eightfold. Right now, we're only a little past fourfold. What if gold goes to 8,000 again? And silver goes up, breaks out versus gold, which it's done, and goes up to, 3%, 6%. Those are numbers it was at in 2011 when gold had that bull market run up into 2011, which was the second hit up at 50. Silver spread then was 3.1% of the price of gold. Right now, we're just 2%. In 1980, when it had that surge to $50 for the first time, it was 6.5% of the price of an ounce of gold. Wow. Consider those numbers, okay?
Wow, indeed.
That's what gold is the other side of. It's real money. They can't inflate it. They can't manipulate it. They tried to manipulate silver by keeping a lid on it. And usually when somebody tries to manipulate a market, whether there's some big trader or government, and they're doing the wrong thing, and it seems to succeed for a long time, all they're doing is creating compression. So that when it finally does break through their barrier, attempted barrier, it goes even more ape on the upside than it might otherwise, because it's been held back for too long. And so it has a panic on the upside. That's what I think we're starting to see in silver, especially silver and in gold. The T-bond market is on an ambulance stretcher right now, okay? Not just our bonds, the Japanese bonds effectively crashed today, exploded in yield. UK bonds don't look very good. The Western world bonds don't look good. We're no longer talking about a mortgage crisis like 2007 to 8, where this mom and pop lost their home, et cetera, et cetera. We're talking about government debt, markets that dwarf the stock markets. And if you'll look at the T-bond futures, which is what we analyze, 30-year bond futures in the U.S., they crashed between 2020 to 2022 in price. Yields exploded, okay? That price low back in October of 2022 was at 117 on T-bond futures, okay? Just remember that. In the subsequent 3 years, there have been rally attempt after rally attempt. In fact, 3 of them. The 3 is usually all you get to get up out of the hole. Fed can cut rates all they want on the short end, but it doesn't affect the long end rates. And they failed each time. Right now, we're down in the 114s, even traded into the 113s today. Our technical analysis tells us that 3-year process of trying to base or trying to top yields is failing. And then you roll over about another 3 points or so in the bonds below today's low, which when you look at a price chart, that doesn't break below the lows we've seen over the last year or two. But you do that and you could be headed into a bond panic. Well, you can't have a U.S. debt market panic. That's like a nuclear event. The Fed knows that. They're the printers, and they print gold higher because they destroy their own money in the process of printing. In November, the president of the New York Fed, Williams, said in a speech or press conference, the Fed is now going to start buying bonds. And his excuse was, just to provide more liquidity in that market. You look at what's going on in bonds since he said that statement, slab down, sideways, dead as heck for 2 months, couldn't move. It's like it didn't even look like the bond market anymore. In our analysis of some prior surging moves in silver, for example, in 79 to 80, where it went up like 5-fold in 5 months.
Yeah.
September 2010, April 2011, up 2.5 in 7 months. In the middle of each of those explosions, and we're in a bigger one now, but in the middle of that clock, there was what you could call a stumble or a correction. For instance, in January 2011, in the $20 plus range, you had a monthly reversal in silver where it made a high and it closed down on the month. So price chart technicians would say, oh, that's a reversal month. You turned around the next month, it blew the lid off of it again, even more than you'd done. But you had a midpoint stumble. If this T-bond event continues for another day or two, you're going to panic the Fed in a way you've not seen before. I know everybody's going to want to blame it on Trump, but frankly, the underlying fundamentals that are decrepit and have been bad for decades is the ongoing inflation in the money units. No, we're not the Weimar Republic, but in effect, we're doing the same thing in a miniature form. You print, prices of everything goes up, bread, stock market, some things go up more, gold. If you own gold for the last 10 years, you beat the heck out of the S&P. But it's all false. It's distortions. And you can't keep playing that game because finally you'll have an accident. Not really an accident, but a consequence. Like in the government bond markets, that is so huge that it causes intellectual doubt among academicians, among the voting public who thought certain things were going to happen on a good way after Trump got elected, but they're going the other way. Apparently, neither party works. So when nothing works and your retirement account suddenly, let's say in the next couple months on the S&P, wipes out all of 2015's gains, which is only 15%, then suddenly you as a person in the street, what the heck? It's 52 card pickup. You are uncertain. Therefore, what happens? Emotion. And when emotion comes in, whoa, that's when
Panic.
it's like a nuclear event almost. Trump said, I'm going to keep gas prices down. Right now, our technical analysis of oil, forget all the headlines, because the headlines are, all the fundamentalists say we're going to 40. Fine, I love that. They'll get ambushed. The technical suggests about a handful of dollars above where you're trading, less than a handful of dollars above where you're trading right now as we speak, which is back above 60. You're going to trigger some technicals that could violently move oil up out of this 60, 70 range and probably on the first thrust get us into the 90s. A 50% increase from recent prices. That would jolt, again, the average Joe when he pumps that gas and sees the clicking. Even then, that's how he sees inflation. He doesn't see it with the money growth. He really should, because every decade, about an 80% increase to 90% increase in the money supply. So like when your granddad built the house, it was $4,500. When your dad built one, it was $45,000. Median home now is $450,000. What's going on? Decay in the money unit over one very long human lifetime.
Exactly.
And that awareness, people don't look at that factor. They look at CPI and stuff like that. But that will be impacted, of course, by increase in the money supply. So when they print more to save the bonds, gold will go berserk because it's real money. Half the world already realizes that and is starting to shift to maybe going to gold again. And the Western world, which is a laggard on that issue, might, if they get into a crisis, finally say, hey, this hasn't been working.